In this video, I want to talk about a very unexpected way to 10x your capital that's not very often talked about. And along the way, I'll keep you posted on what I've been up to because there's been a lot of changes and I want to keep you up to date. Of course, I'll wrap up the video with a portfolio update and my thoughts on the blowout earnings from Disney. But this video is definitely not for the faint-hearted and quite personal to me. So I have left timestamps in the description box below. So feel free to jump to a section, whichever that is most relevant to you. As usual, it will mean the world to me if you could gently smash a like button if you have learned something new. And if you really enjoy what I'm doing, consider supporting the channel via Patreon. And no, this video is not financial advice or recommendation to do anything. So without further ado, let's go. In my previous videos, a lot of you actually left comments on why I am not investing in air conditioning for my place, but instead trying to save money wearing massive jackets like this. The truth is, my Asian heritage have taught me to
basically put on more clothes, wear double the socks or double the t-shirts when it's cold.
So air conditioning, unless I'm desperate, it's not gonna happen. At the same time, I was zipping up my jacket to cover up the skin allergic reaction that I had all over my body. And it was important for me to do that because when we spend time together, I want to focus on adding value to your life. And especially whether that you're watching this video from Australia or across the world, the lockdown have put a lot of pressure on all of us. And I didn't want to contribute to adding more concerns. I just want to make sure that when we spend time together, it's both fruitful and valuable. I'm recovering pretty well now, as you can see, so I'm all good, don't worry. On top of that, throughout this year, I've been really fortunate to have companies that want me to work on their marketing or come in and lead their growth team. The problem is that one of the companies is a leading ETF provider in Australia, and if I was gonna work for them, then it means that I have to give up this YouTube channel completely. It's a reasonable request because of compliance, but our relationship means so much to me and we all work so hard to build up this channel. I was just not ready to give up this channel. Long story short, I said no to a bunch of opportunities, but there was one that came up that I really just couldn't say no to. And it was a chance to work with really smart people and tackling really tough problems in the healthcare space. It was one of those things that it was the right place, right time, and I just had to grab the opportunity with two hands. So about 2 weeks ago, I joined one of Australia's fastest growing healthcare startups called Eucalyptus as a growth product manager. And I have left the link in the description box below for any of you who are interested to learn more about the company. This is a really good transition to talk about another way to 10x your capital. As part of working in a startup, your compensation package, you actually get a choice to choose whether you do want to own a piece of the company in the future. The whole idea of allowing employees to have part ownership is not just to incentivize them to stay longer, but to really compensate you for the risk that you take on by joining the company very early on. It's almost like having the ability to invest in Coinbase when they were worth $100 million as a private company, and now they're worth $50 billion. But of course, that's only if the company works out. There's always a chance that it just might not work out to that extent. So this is where you have to do your due diligence, like investing in a stock. What is the management team like? What about their ability to attract talent? What about their business model? Frankly, for me, one of the things that drew me to the company is their ability to attract talent, and some of the best ones across Australia and beyond. Having a chance to learn from great people, even if I don't 10x my capital financially, I would have 10x my technical skills, which will ultimately translate to actually better content for you and also way better salary expectations down the track. While there are definitely plenty of opportunities to grow our net worth via traditional means like property, stocks, or crypto, working in an early stage company is definitely one of the more controversial ways to 10x your capital. And I would love to know what you think about that in the comment section below. Now, before I go through a portfolio update, I want to quickly react to the Disney earnings result because I think this is really interesting. As of recording this video, Disney trading at $181 per share at a $329 billion worth of market cap. Now, the headline for this result is really all about streaming. And the Disney Plus subscribers have hit 160 million subscribers versus an expected 112 million subscribers. And if you add up ESPN Plus and also Hulu, the company is close to 174 million subscribers. And to put things in perspective, Disney Plus was launched towards the end of 2019, and Netflix currently have close to 200 million subscribers. So in a very short span of time, Disney was able to not just reinvent itself, but catch up to one of the streaming giants, which is kind of the headline for this earnings result. Now, revenues have grew by 45% to $17 billion, and the company swung back to almost $1 billion worth of profit from last year's $4.84 billion worth of loss. Again, to put things in perspective, most of Disney's revenue actually didn't come from streaming before the end of 2019. A lot of it came from cruises, experiences, and theme park revenue. So when the pandemic happened, there was just no way for Disney to make money other than streaming. So this is actually one of the main reasons why Disney was trading at a pretty high and hefty multiple recently. And this brings me to some of the analysts' concern. One of the main concern is that some analysts believe that Disney is overvalued because they are trading like a streaming company. Now, from my perspective, I have pulled up the EV/EBITDA multiple, the forward-looking one, between Netflix and Disney. So if Disney were to trade at a closer to like a streaming company, then they should be much closer to a 30 times forward EV/EBITDA. But we all know the market is not likely going to reward Disney with that kind of multiple just because Disney has a theme park and also cruise services. And those kind of services and revenue segments has a higher capital expenditure and lower margins. So it's just not appropriate to reward Disney with that kind of multiple. So from the perspective of saying that Disney is overvalued because it trades like a streaming company, I don't know if I really buy that. On top of that, if I just go back to the screenshot for a second, some of the analysts are concerned in terms of where these subscribers are coming from. Are they coming from lower tier countries where Disney is charging a lower price for these subscriptions, or are they coming domestically in either Australia or even US? So I think whenever there are mixed opinions about a company and no one have really made up their mind, I think this is a great time to not just revisit your thesis, but it's more likely that we are onto something because no one actually agrees whether the company is undervalued or overvalued, whether the company is good overall. So for me, the Walt Disney Company have a 100-year history. And during this time, if we look back 100 years ago, there isn't that many companies that are still listed in today's stock exchange. That's number one. And secondly, Disney have actually proven itself to continue to reinvent itself. And they're able to acquire companies like Marvel and Lucasfilms and Pixar to develop new content under their brands. I think Disney buying Marvel is a really good example. Not only were they able to create a cinematic universe through some of the characters, Disney was also able to pull out some of the characters and build independent series on each of them. Now, The Falcon and the Winter Soldier, I really enjoyed that series. And I've heard really good things about Loki that I have not watched the series yet. And a lot of people are telling me that I should. So please no spoilers in the comment section below. But more importantly, I've talked about Disney on my channel many times before. I think what makes Disney really special is not only their ability to create content and create content for both cinema and also streaming, they can also leverage off that content to build experiences in both theme parks and cruises. And I think that's something that Netflix is still trying to figure out. Now, if Netflix wasn't trying to figure that out, then they wouldn't start a shop to try and sell merchandise on The Witcher. And finally, if you look at the analyst projections between Disney and Netflix, between 2021 and 2022, Disney is anticipated to grow at 25%. And they're currently generating $65 billion worth of revenue. So they're going to grow to $85 billion. Whereas Netflix has a higher multiple, but is anticipated to grow at 14%. Even if analysts are screaming that Disney is overvalued, I am not going to sell my Disney stock whatsoever. For my portfolio side of things, my CMC market is worth 108,000 Australian dollars. And not too many changes on this side other than depositing a little bit more cash. And yes, there are some concerns around both Asia and Micron. I've talked about Asia many times on my channel, so even with the political concerns, so not going to sell, I'm just going to hold it there. When it comes to Micron Tech, Morgan Stanley released a report essentially saying that there might be a lack of demand for DRAM chips in the future, which is like the exact opposite of what the CFO said from Micron. I will actually lean more towards believing internal employees instead of believing investment banks, just because there's conflicting interests. I just much prefer to listen to internal employees. With my stake portfolio, it's currently worth 46,000 US dollars. So that's approximately 60,000 Australian dollars, give or take. And I've deployed the rest of the cash into CVS just because I didn't feel comfortable having some spare cash lying around. And I bought some extra Snowflake shares as well. So whatever odd amount I had left, I just added them into Snowflake. Now with my positions, I'm actually really happy with them. I know I keep saying that every single week, but I have some more cash on the CMC market side that I need to deploy. And I'll probably add a little bit more cash on this side as well. I know that's really annoying that I have to jump between ShareSite and also Stake to show you two different accounts, but hopefully in the future, I can just unify everything under the same dashboard. As usual, I'm not sponsored by Stake, but if you do want to try Stake for yourself, I have left a link in the description box below. Thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.